Sean Peche from Ranmore Funds, one of the top money managers in the world. Nice to hear that, isn't it, Sean? He's with us again today to give us his latest insights. And that's not an exaggeration, Sean. We're seeing your funds pop up all over the place now in the performance tables. Nice to see that that you're getting that recognition, but are you getting the recognition from the investing public? Are the tribe allocating gazillions of rands to you?
Alec, well, look, that's very kind of you. Thank you. And, you know, I've been in this game, for want of a better word, long enough to know that you never get complacent and you never think you know it all, because the minute you do, boy, that's when you're going to get knocked off your perch. And it's obviously not just me. I've got a fabulous team. And we're certainly getting a lot of recognition over here, which is encouraging to see. And I think one of the things that I've spent most of my time focusing on is marketing to South Africa and ignoring this huge market here on our doorstep. And, you know, there's some 21 trillion pounds, I think I'm right in saying, managed. You got wealth managers over here, 50 billion plus pounds. There's some huge numbers. And so people are starting to take notice. And I think what's really helped this year is there was a sense, oh, well, value had its little run. Let's, that game's over. And that was a couple of years ago, but we've managed to do really well this year and, you know, substantially better than value and the market actually, which has been led by growth. And so we've been able to do well without having the AI and the FANGs and all of those guys that have really driven the market. So I think people are taking notice of that, and it's an exciting place to be. And it's just the most amazing. I mean, I was just making a few notes as to what we could possibly talk about today. You know, every day you come to work, there's something different, and that's what makes it exciting. And so yeah, loving it. And but I've had the stressful times, so that's all good. You know, there's some just around the corner, so we'll just roll with the punches.
Yeah, I was reading something this morning which said that we have challenges in our lives so that we can grow. Imagine how else you can grow if there were no challenges, if life was just a smooth sailing. And certainly you're a veteran now, I guess you could call it, in money management. And before people get a bit confused, you're based in the UK, have been for many years. You clearly are South African by accent and by training, and Alan Gray, Simon Murray, all of that kind of heritage that you have. And you do come to our conference and you give us your insights. You're going to be back at the Biz News Conference, big one in March next year. But interesting to hear that it's taken this long to get recognized in that huge UK market. Why?
Because I guess because I'm in charge of marketing. But I haven't, Alec, I haven't focused here. You know, it's always been thinking, well, hang on, I know the guys back home and maybe they relate to me better. And you always sort of think, well, I didn't go to the fancy schools over here and that it's going to be tougher to break in. But actually, that's been an error of mine. And it's taken me a long time to figure that out. And the UK is a very cosmopolitan place, and people are actually quite welcoming. And I don't know why I thought otherwise. But it's good to see. And I must share a funny story with you. You know, obviously both our children were born here. But my son was working at a golf club over the university holidays, and there was a South African chap who came playing. He says to him, Anthony says to him, "So you South African?" And the guy goes, "Yeah." So he says, "Well, I'm also South African." Okay, he's born here. And his bar manager turned to him and said, "You're South African. That is the poshest South African accent I've ever heard." Anyway, so very much South African, and it's great to be in touch and all the rest. So yeah, good, but having fun.
Well, we never lose our blood, our heritage, and
no, we don't.
We have our challenges, but my goodness, we're growing through them. From your side, though, having a look at the markets, because that's really where the action is, and that's the purpose of this conversation. By the way, we haven't spoken as often as we should be doing, so I think that's both of our problems on that one. We'll fix that in future, but things are very turbulent. Our Biz News portfolio was swimmingly well because it is an exponential portfolio, and it's had two very rough months where I think it's a drop of about 10% in the growth stocks over this period. From your side, though, you've ridden it up, even though you aren't focused on growth, and you're still riding it up despite the changes that we're seeing now. So, what's your secret power?
It's Alec. I tell you what, top tip I can give you this episode is I've nearly finished a book called Richer, Wiser, Happier by William Green, and I recommend everybody read it. And this chap, William Green, interviews the top money managers from Sir John Templeton and Monish Pabrai and all those guys. Okay, and it's really interesting. I think it's a great read. So what's the secret sauce? We bottom up investors. We're not. And the interesting thing is, just on that, people often ask, what do you think about macro? What's going to happen with inflation? What's going to happen with interest rates and all the rest? And I asked a money manager the other day, a consultant who's interviewing me, and I said, what percentage of macro calls do you think people get right? And I said, do you think it's 50%? He said, it's way lower. So I said, what's interesting is by being a bottom-up investor and not taking a macro call, because we don't really make macro calls and guess where inflation is going to be, which most people do. Okay. But if the most people guess what's going to happen on the macro side and only get it right, let's say gratuitously 50%, and I'm not taking the macro call, but I'm taking advantage of the bottom-up stocks, by default, I'm getting it right 50%. So let me give you an example. If people are guessing that oil price is going to fall, you're going to have a recession, oil prices therefore going to fall. And I'm buying these oil stocks, last year or whatever it was, at the lows, and the oil price doesn't fall, well, I've got a bargain. If the oil price does fall, well, it was in the price. Do you see the asymmetry? People thought there's going to be a recession in Europe, and so they were selling European stocks, and we're picking up these bargains. And guess what? There wasn't a recession in Europe. And so we got these bargains. But so our default call, you might have said, oh, well, you made a macro call that there wasn't going to be a recession in Europe. We did by default. And so we got these stocks at the lows. But had there been a recession, well, we bought them low anyway. So that is the beauty of it. Do you see what I mean? But it's amazing how markets are constantly changing. And, you just look at some of the factors driving them now. A week ago, 2 weeks ago, we weren't really worrying about the US shutdown. Now there's a risk. You got some rogue Republicans. What's going to happen? It's all supposed to kick off on the 1st. So you've got oil back at $94. Well, not long ago, everyone was celebrating inflation coming down, and so what were people doing? They were, and this is what most people try and do. They say, okay, well, we've got to guess interest rates, because if we guess interest rates, that'll tell us what to do with the tech stocks. Now, how do we guess interest rates? Well, we've got to guess inflation. So let's all focus on inflation. Inflation's coming down. Great. Interest rates are going to come back down. That's good for tech. That's what you see. Throw in the AI. Well, guess what? Inflation has come down historically. Now you got oil back at $94. So what's going to happen to forward inflation? Maybe it's going to be higher. And maybe even if you got the inflation call right, okay, inflation is going to come down. Well, it hasn't helped interest rates. The 10-year in the US is close to 5%. It hasn't been that level since 2007. And if I can go and invest in a 10-year government bond in the US at 5%, call it 4.8, why would I want to buy Microsoft yielding 2%? If they gave me all their earnings as dividends, I'd be buying Microsoft in a 2.3% dividend yield. That's all their earnings, 100% payout. Okay, that's half of the government bond in the US. Now you say, okay, well, because Microsoft's going to grow. Well, it better grow, because if it doesn't, it's got a lot of downside. It's got a half to be equal to the 10-year, and the same for Apple, and the same for all these things. So I think interest rates are going to be a big factor, and I think people have been, ignoring that, focusing on inflation. Let's get inflation down. If it does, it's come down. Well, now you've got the oil price throwing a spanner in the works. So let's see. We've got bad weather. What's that going to do to food prices? So the market's always got, and then you've got things like the FTC case against Amazon. You've got Microsoft spending most of their cash buying Activision. And you've got huge concentration. So you now look at the market and you say, everybody is overweight the US. because it's 70% of the world index. Within that, everybody is overweight tech stocks because Apple and Microsoft are 25% of the NASDAQ 100. So if everybody's already there, who's the marginal buyer? I mean, who doesn't know that Microsoft's a wonderful company and Alphabet's a wonderful company and all the rest? Who is the marginal buyer? Because retail, interestingly, this is one of the first dips in a long time that retail have not been putting their money to work. And maybe it's because they've got blown out the water buying these one-day option one day to expiry options. And so those are basically, it's going to the roulette table, put the money on black. That black doesn't come up, you've lost everything. So there's lots of factors. And what's interesting to me, Alec, is if you look at the market, so the market year to date is up 10.5%, and growth is way ahead of value. Growth's up 20, quality's up 17, value's up 2. But month to date, value's down, 3, and growth's down 6.5, and quality's down nearly 6. So you've had a complete reversal. And all these people who look back and go, well, if it's tough times, what happens is growth and quality always outperform at tough times. Well, we've had a tough month or two, and what's happened to that? So maybe that's turned on its head. So, market doesn't sit still. If you look at regions, North America's up 11, Asia is up 1.5. But this month, North America's down 5, Asia's only down 2.5. Who's talking about Asian stocks?
It's so interesting, but I want to maybe move it to a different area that we've never really spoken about. I read an incredible speech actually by a guy called David Ansara, who's the new chief executive of the Free Market Foundation. It's on BizNews, it's well worth reading, where he unpacks the South African situation and then talks about the disruption and making yourself state-proof, in that the way we always used to think Pretoria will provide is over. And perhaps Pretoria or perhaps South Africa's ahead of the curve here, in that this is a dysfunctional government, it's a failing state, etc. And as an individual, you have to do things differently. But what about the investment markets? The way that you've articulated it, this has to be ripe for disruption. If you think the point is some economist at some big corporation makes a call on interest rates, that then seeps all the way through that organization who's managing your money. But the chances, he's only going to get it 50% right if he's lucky, because no one knows the future, especially in these big issues. Even Warren Buffett says, I don't look at the big terms. Surely that would mean that as people become better informed, as they understand more about performances, as they understand more about the people that they give their money to, i.e. like Ranmore, like yourself, they will move their investment decisions or adjust them in a different way. And I can just take your example, and I know it's uncomfortable being the person discussed here, but think of Magnus Haystack. He's a completely independent financial advisor. That's why I love Magnus so much. He says it as he sees it, and he's beholden to nobody. He's put quite a lot of money, of his clients' money, into Ranmore because he's seen Sean Peche, he's seen what you're doing, he's seen the performance that you're doing, and he's done so. He's made that call. My question here is, surely there are lots more Sean Peches around, lots more Ranmores around, who are going to be these boutique funds who are outperforming because they're not being told by head office what they have to buy and sell. And that disruption, which we've seen in government, we've seen it in big business, is that coming to big money?
Alec, I hope so. The problem is we've had disruption the other way. We've had the disruption of the passives, and the passives are now 50%. And there's, you'll know Howard Marks, he always talks about first level thinking and second level thinking, okay? And which I really like. And whenever we're looking at a company and all the rest, you go, well, that's what the market's saying, that's first level thinking. What's the second level? We've got to dig a bit deeper. Always got to do that. And what's the first level thinking on passives? Most active managers underperform their benchmark, okay, by the fees. Therefore, we must go for passives. But what's the second level? Well, that's been an easy call in the last 10 years because the markets have gone up, okay? And it doesn't, if you just performed in line with the benchmark in a rising market, fabulous, you got wealthy. And you got wealthy in real terms because interest rates were low. But who wants to perform in line with a falling benchmark? Okay, that's the second level thinking, because benchmarks don't only go up. And what happens if that benchmark is crazy, as it was a couple of years ago when you had Zoom and Peloton and, Beyond Meat and PayPal and wind farms and all these things, these themes that sort of captured everybody's imagination and drew these, of course I underperformed there, but was that a sensible use of money to just throw it in there and say, well, let's perform in line with that? I mean, you think about I was thinking the other day about a property investor. You imagine speaking to a private property investor and you say, well, how do you make your money? Now I build, apartment blocks. You go, well, what's your exposure to shopping centers? You go, well, no, that's not my game. I focus on apartment blocks. Yeah, but shopping centers in the property benchmark. What's your exposure to warehouses? No, I don't do that. Oh, that's in the benchmark. You got to have it because it's in the benchmark. And this whole benchmark thing. Now, the problem is, for boutiques, is there's been massive pressure on fees. And so you boutiques, you small, you have to, so you've had massive pressure on fees. Some of the fees are fixed because we pay our external directors and money laundering risk officer and, legal and audit and all that sort of stuff. Those are fixed costs. And you'll pay those directors those fees, whether you're $100 million or you're $1 billion, it's the same fee. But at $100 million, those directors' fees are more as a bigger percentage of your annual fee. And so with this focus on fees and focus on, because driven by the passives, well, I can go buy S&P of 20 bips or whatever the number is, it's been tough for the boutiques. And so few have survived and the ones that have probably been growth guys. People forget that Fundsmith was once upon a time $50 million or Lindsell Train was $50 million. These guys all grew out of boutiques.
And how big are they now?
Fundsmith was, last time I checked, 25 billion pounds. Lindsell Train, I think it was like 8 billion pounds. These are massive. So they did something slightly different. So, but if you look at all the evidence suggests that boutiques outperform the large fund managers and especially I would argue, I think I'd make a strong case for this going forward because the large caps is what's driven the performance. And the big fund managers are stuck in the large caps. They can't go and buy a Mizuno or AECI or whatever. That's where the value is because the passives have all been market cap weighted. So they've all driven up Apple and Microsoft and all those guys, ignoring the little guys. I did a webinar recently in South Africa, which was quite interesting. And I looked at Walmart. And if I said to you, Alec, what earnings growth do you think Walmart's had over the last 10 years? It might surprise you to know that the earnings per share growth has only been 2% compound per annum. Okay, 2%. Yeah. And that has been helped by buybacks. The share price is up 8%. And so that means, and it doesn't sound like a lot, but that means that basically it's doubled. So the price earnings multiple's gone from 14 to 30. So people are paying 30 times earnings for Walmart. That is historically grown earnings at 2%. And that's when interest rates were low and people could go and buy stuff. If you look at the fastest part of what's growing within Walmart, it's grocery. And you go and look at a company like Kroger, which is the second largest food retailer in the US, they have grown earnings at 12%, not 12. And the share price has also gone up at the same rate. So the share price hasn't re-rated. And what does that mean? Well, it means you were paying 11 times earnings for Kroger 10 years ago, and you're still paying 11 times earnings for Kroger. So you look at it, you go, well, do I want to pay 30 times earnings for a big, giant that actually has made some terrible calls? If you look at macro and you look at some of these other things, I'm paying 30 times earnings for a business that's not really growing. I could pay 11 times for a business that has historically grown much faster and is exposed to the fastest growing today. And if the paw hits the fan, well, we still got to eat. And that is the kind of opportunity that's out there in the small and the mid caps that the big guys can't take advantage of. And that is why boutiques should outperform the big guys. Yeah.
Sean, before we go, I'd really like to get your thoughts on banking. And the reason for this is that Koki Koiman, who we both know, tells us that banking stocks are at their cheapest ever. But thinking about it, banks are also the area where there's the most disruption. You have fintechs coming at them from all angles. They've got to be affecting the banking opportunity or the profits into the future. The reason why banking shares are the same place that they were 10 years ago is because they haven't been growing their profits. What's your thought on that? Do you look at that and say, I don't care. It's extremely good value. I'm buying them at a price to book of 1 or slightly over 1. They're going to come back at some point in time. Or is there this disruptive force that is so powerful and has to be so powerful that you can't really look at what used to happen in the past as a good barometer for the future?
No, Alec, they're nowhere near 1. We've got banks in the portfolio at 0.35 times book value, okay, which means that if they just, shut up shop, collected their debts, paid the creditors, you'd make multiples of your money. And these are big European banks. Now, they haven't grown because interest rates have been next to nothing, and that is their price. So, we've got a mortgage on our house. I pay 0.97%, which has been fixed for 5 years. And so you look at this, and somebody wants to lend you money at 1% for 5 years, you take it, okay, because you can do better than that elsewhere. And so interest rates have been low, and that is why they have battled to grow. That's been possibly very difficult for them to grow, but some of them have. And I'm talking about Western markets, okay. But I think they're good businesses, because if you think about it, you've got annuity income. If people are borrowing money from banks, they know what they're going to earn in interest for the next 20 years. Okay, Apple doesn't know how many iPhones they're going to sell next quarter, and guess what? You're going to pay your mortgage before you buy your holiday or pay for your iPhone. So people, I think they've been terrible businesses, but they shouldn't be. There are bad ones, like Credit Suisse. Went bust because it was badly managed. But if you think about it, if you look at the age, some of these banks, and I remember the late great Simon Moret used to say this. He said some of the oldest businesses in the world are banks, so they can't be that bad. Now, what about the disruption? Well, have a look at the price of PayPal and tell me how damaging that's been. And actually, if anything, banks can use technology to their advantage. Look at the apps. When last did you go into a branch? I haven't been in for a long time. So they can actually use technology, and we'll be able to use things like ChatGPT. You go onto these apps and you want some assistance. Well, you've got a bot that's helping you through most of the way. So they can use technology. I think the fintech, everybody has been throwing money at this fintech. You've had the media companies, the Naspers, the banks, the insurance, etc. Everyone been trying to crack the code. Go and have a look at the share price of Adyen. I think it's down like 50% this year, and they're supposedly one of the big disruptors in terms of the payments. So I think that's more of a perceived fear than actual fear. I still use a bank. I use my app, etc. I've got annuity income. I'm buying. ABN AMRO is on, half book value, 10% dividend yield, and 5 times earnings. Compare that to what I was saying just now with Microsoft. Now, is Microsoft a better business? It's certainly perceived as being a better business. It's rated as a much better business. But I haven't got a 2% dividend yield from Microsoft. I'd only have a 2% dividend yield if they paid out all their earnings. And yet I've got a 10% on ABN AMRO, and that's not paying out all their earnings. So, but they've been ignored. And that's what I'm saying. The market always changes. Okay. And people who are looking back in the last 10, who drives a car? You don't drive your car looking in your rearview mirror unless you're going in reverse or you're on a very straight road. Well, we're not on a straight road, and I don't want to go in reverse. So, so I agree with Corky, I'm pleased to say.
Sean Peche from Ranmore Funds, and I'm Alec Hogg from biznews.com.